I think, was a tough one. It happened in circumstances where you were starting to see an economic recovery, but business and consumer confidence was still low. The drivers, though, of our growth was good balances, so loans and advances, so people were borrowing, so that gave rise to good net interest income, particularly in South Africa. But for the whole group, the net interest income declined because of our operations in Africa regions, mainly also because of declines in interest rates. We saw greater activity by consumers, which resulted in more borrowings and more transactional activity, more people swiping on their cards, more people making payments. And then we had a good decline in the credit charge. So it declined by close to half. So in other words, the bad debt charge was close to half. And then our costs were well managed in our group, managed well below inflation.
When you look at your data in terms of how your customers are interacting with the bank and their appetite for loans, how would you describe their financial position at this point? I mean, what is the data from Standard Bank's point of view showing about your customers?
Nastassia, it's a complicated situation, in that if you just look at the Standard Bank's book, you will see that our loans expanded by roughly 10%, which suggests that consumers were borrowing, and they were borrowing to buy homes, to buy cars, and in many instances for consumption. Many of those customers, I suppose, fall into the affluent category or affluent segment, but the more precarious sections of South African society, particularly those that worked in sectors that were hard hit by COVID and the shutdown, had difficulty in terms of making payments when they fell due. In other words, many people lost their jobs or they were just not being paid. And so it's a mixed bag in that sense.
Right. I found it quite interesting that your top 6 regions performed quite well: Angola, Ghana, Kenya, Mozambique, Nigeria, and Uganda. What is driving that?
The IMF predicts that the African economies will grow at roughly 3.4% this year. That's significantly slower than the rest of the world, right? The world is built to grow at roughly 6% this year. But the main reason for that difference is that Africa had a different base of which it was growing. In the case of Africa, you didn't have as much of a smash up from COVID in 2020 as you had in the rest of the world. So again, if you compare it to South Africa, we had a negative a GDP in South Africa, and therefore the base was much lower and the recovery is therefore much faster. You saw, of course, also a recovery in commodity prices, which drive a lot of the African countries' economies. And then you saw a lot of these countries took advantage of the dislocated value chains, particularly the East Africans. They got involved in the value chains that have been dislocated, particularly in the Far East.
Right. So by the time our interview airs, which will be this afternoon around noon, you would have already outlined the bank's broader strategic aims, as well as the modalities of advancing the bank's goals. Perhaps you can let us in on what some of the points that you're going to be driving forward, and what this new model for Standard Bank will look like.
Nastassia, we're going to be we will have told the market this morning that the main reason why an investor should be investing in Standard Bank is that Standard Bank has got scale. Financial services is a scale business, and that we are represented in 20 countries, making us relevant to multinational corporations and domestic corporations, and relevant to them in a way that our competitors are unable to be. We'll also be telling investors that we have reorganized our business to take advantage of these scale advantages by dividing the business into 3 segments: consumer high net worth, business and commercial and wholesale segment, supported by our client solutions business, as well as engineering and innovation. That change is making the organization more customer-centric and should improve customer experience, therefore increase revenues from customers and generate better returns for our shareholders. In essence, we'll be operating as a platform business where we are coordinating activities between buyers, sellers, investors, importers and exporters, and governing those relationships on our infrastructure, IT platforms and systems. And we'll also be driving partnerships very, very hard. It's an exciting time for the Standard Bank Group. It's a brave new world where we will be confronting the incumbents, our competitors, the incumbents, the telcos, the fintechs, and partnering with them where it's necessary.
Right.
That's the essence of our...
Yeah. So let's talk about, your outlook, your macroeconomic outlook. I mean, when you're having your conversation with some of your in-house economists and some of the information you're gathering from a financial news point of view, the Fed Reserve has been making headlines over the past couple of weeks or so. At the back of your mind, is there concern that once liquidity is tapered down, there might be that shock in the global economy? Or do you think that at some point we are kind of prepared for it because we've been talking about it for weeks and months now?
Nastassia, we take a long-term view, 10, 20, 30 years, and we therefore believe that the world is on an upward trajectory in the long term. Greater globalization, greater integration of value chains, greater integration of economies, and that this is a process that's been on the go for decades, indeed for centuries, if I could put it that way as well. So that is philosophically where we stand. Secondly, we see the short-term events that started day before yesterday and yesterday as just that. They're short-term. The Fed is doing what we would have expected them to do at some point. At some point, there's going to be tapering. We're also not surprised given the noises that have been coming out of China. And so at some point, the stimulus is going to come to an end and the economy is going to have to adjust. But we don't see that as a long-term problem. We see it as a short-term